What if the money for your next deal isn't coming from your network? It's sitting in a retirement account, just waiting to be used. In this episode, I'm joined by Dana Udumulla, an SDIRA expert, to break down how you can invest in real estate using retirement funds. We cover how to structure these deals the right way, avoid costly mistakes, and unlock one of the most powerful and overlooked ways to raise capital for your deals. Welcome to the InvestHER Podcast. I'm Liz Faircloth.
And I am your co-host, Andressa Gadelli.
So Dana, so many real estate investors hit a wall, not because they lack deals, but because they don't have the capital to grow. So in today's economy, where should they be actually looking for money?
Liz, you wouldn't believe me if I told you there's $14 trillion worth of capital. It's out there in the economy and no one knows it exists. There's $14 trillion worth of retirement money just sitting in IRAs. And especially right now, this economy, people are trying to diversify it outside of the stock market. They're trying to get into more steady return asset classes like real estate. And so when anyone comes up to me, and I work with a lot of sponsors across multiple different industries, real estate being one of popular, and they ask me, where do I find these deals? Where do I find this capital? I always tell them, have you heard about raising capital through self-directed IRAs? Because this is what I call long-term patient capital. And trust me, if you haven't heard it, your investors doesn't know that they can get into your deals using their IRAs either.
So let's take a step back. $14 trillion, meaning that is in all retirement accounts, or is that specifically in self-directed accounts? So break that down for me. I'm curious.
So it's actually $44 trillion in all retirement accounts. So I'm talking 401ks, 403bs, IRAs. Out of that, $14 trillion is in IRAs, which is individual retirement accounts. And part of that is in self-directed IRAs, but majority of it is in Wall Street products, right? Traditional securities, stocks, and bonds. But the thing I really want to emphasize here is if this money is in any sort of a retirement account, it can be either transferred or rolled over into a self-directed IRA because there's a huge portability aspect that you are able to transfer this money into a self-directed IRA without those tax consequences.
Okay, I want to come back to that, but I really want to speak to that for those listening that don't even know how to leverage, right, that particular strategy. But I want to know also just globally, out of this $14 trillion in IRAs, what percent is invested in real estate? Because quite honestly, real estate is still considered an alternative investment strategy. So I'm curious though, what percent would you say of that $14 trillion is invested in hard assets, like I like to say, real estate?
I'm going to tell you it's going to be less than 5% because again, majority of the American public and even accredited investors, sophisticated investors, real estate professionals don't know that this is a thing. This has been in existence since 1975. And really the educational component is coming right now. Like recently, everyone's talking about it. But before that, the usual was like, okay, you start your job, you put money into your 401k and then 60-40 split, right? So I can tell you, Liz, like less than 5% of it is invested in real estate because also alternative investments is so broad, right? Real estate is
absolutely
one aspect, one asset class. And then there's private equity, there is private credit. Now with the digital age, we have cryptocurrency coming up as an asset class. So really, there's a huge potential here for real estate professionals to leverage this because a lot of the people out there, investors, especially the ones I've worked with, once they didn't know that this was possible, that they can use their retirement accounts to get into real estate. Because really, that's the American dream, right? You're able to own real estate. You're able to have real estate as investments. And if they can do it through their retirement accounts, their IRAs, with the option of maximizing those tax advantages, why wouldn't you do it?
So let's talk about, because obviously people are going to need to get a little more information, and obviously we can give them resources at the end. But I really want to speak to those listening that, one, how do I leverage the retirement accounts that I have? And then two, how do I leverage the retirement accounts of others so that I can grow my wealth by buying more property? And that's really how I scaled our portfolio, whether it was through equity and buying more properties with partners, or lenders, right? People would lend from their self-directed. So let's take the first step though. Let's dive into, okay, I'm listening to this. I have a retirement account. How do I know if I have the appropriate retirement account structure for being able to invest in say real estate? Because if they're listening to this, they want to either grow their portfolio or buy their next property. Let's be honest. So is there a specific type of account, retirement account, under the self-directed sphere, if you will, that I need to have so that I can utilize it to buy my next property?
First of all, Liz, I love that you're asking these questions because these are the questions that people always ask because they're not sure, right? So self-directed IRAs is basically a type of IRA where you, as the owner of the IRA, you're able to self-direct the money in your IRA into alternative investments that is outside of stocks and bonds. Within self-directed IRAs, there's the usual types of IRAs. We're talking traditional, Roth, SEP, simple, inherited IRAs. I always tell my clients when they ask me this question, really the type, anytime you have retirement money anywhere, whether it's a 401k, another IRA at one of those big brokerages, you can transfer that into a self-directed IRA. But then you have to ask yourself the question, do you want a tax-deferred IRA? That is, you are not paying the taxes right now, but at retirement, when you're taking the funds out, you're going to be paying taxes. That's a traditional IRA. We call them pre-taxed IRAs. Or do you want the tax-free option? Now, when I say tax-free, everyone is like, Dana, nothing is really tax-free. Well, you are right. But the Roth IRA was created for the purpose of you pay the taxes up front. So if you don't have a Roth IRA, you can do a Roth conversion of a traditional IRA into a Roth IRA. Pay the taxes on the amount you converted up front right now. So you're basically paying your income tax bracket at this time on a smaller amount. Then you can invest that again to real estate, and the appreciations from that point on grow tax-free. Granted, you have the Roth account for 5 years, and at the age of 59 and a half, you're able to take either funds out or the entire property out. Again, lesser known fact, people don't know. You can actually take the property out of the Roth IRA to yourself, like possess it to yourself at that time, completely tax-free. So at this point, I tell clients, you need to understand what your financial situation is and what your long-term financial goals are. Do you prefer to defer the taxes because you don't want to pay that tax bill right now? Or do you want to pay that tax bill on a smaller amount right now and really capture the tax-free growth on the appreciation or the returns until later? Most of the time, and of course, we're passive custodians, Madison Trust, so we always recommend our clients to speak with their financial professionals when they make this decision. But most of the time, my clients use that option of a Roth IRA because, especially in real estate, even if you're buying one property, it's going to appreciate over time. And they want to capture that appreciation completely tax-free.
It makes a lot of sense. So let's go back to something you said, because I don't think many people realize this. And I know this is something that we often have done because we work with hundreds of investors over the years with various projects that we've done, right, in terms of syndications and things. So you have a 401k in a particular company. That 401k has been, in a sense, invested in different sort of paper assets and the stock market or what have you. It needs to be, am I correct in saying this? It needs to be in a self-directed if you're going to choose to invest it in real estate. Is that correct, or am I not correct in saying that?
So that is correct. But then there's, of course, a lot of nuances when it comes to 401ks, right?
Sure.
Now, one thing is, if the 401k was with a previous employer, you're no longer with that employer, you're absolutely able to take the entire amount of the 401k, roll it into a self-directed IRA, invest into real estate. Now, if you're still with the employer, you're presently employed, there's a few things we need to go through. First things first, I ask the client to speak with the plan administrator, whoever is administering the 401k, to ask, hey, based on my current plan, what are my options for in-service withdrawals? Like, am I able to take distributions out? If so, then you're absolutely able to send that money from the 401k into a self-directed IRA to invest into real estate. But you're not limited. Just because you are having a 401k with a current employer, you're never truly limited.
Yeah, absolutely. That's why I always like to say, if you're on the side of looking to raise capital for your projects through other people's self-directed IRAs, it's really helpful to know in your circle, in your network, when people are leaving their jobs, because that should spark like a little flag that goes up like, okay, this person's leaving their job. They can at that point correct and not have penalties of converting it to a self-directed. So these are just great things to be mindful of, especially if it's somebody that you've been networking with and you're cultivating a relationship with. Not that you want anyone to lose their job, but if they're between jobs and they're shifting jobs and they're moving to a new job, it should be like, oh, that could be an opportunity for them, right? To convert.
Absolutely. And like especially in like the circles we run, Liz, we know for a fact a lot of the people are leaving their jobs to start their own thing, right? They want to be entrepreneurs. And at that point, this is a great opportunity, especially if you are raising capital for your syndication, to have the conversation, because especially the investors with the entrepreneur mindset, they get it. For them, this is an easy conversation. The only thing you really have to ask, the question you really have to ask, and I speak with a lot of capital, like syndicators all over, and they always ask me, Donna, what do I say here? Like, how do I even start the conversation? It's very simple. Ask that one simple question. Hey, did you know you are able to use your retirement money to invest into this deal and still grow your retirement account tax-free or tax-deferred? Like, you're not going to get penalized. You're still keeping it under your retirement umbrella, but now you have the option to get into this deal and capture this growth. And it's always that simple question. Did you know this is possible? You can get into this deal with your retirement money.
Yeah. And I feel like so many people that are connected to real estate or in this space, they know that. They don't always know how to do it, which you need to have great custodians and advisors around you. But you got to remember, I always like to ask people, how are you making your money? So if you're working with a financial planner and they're not even giving you any insight that this is a possibility, you have to be really cautious in the sense of, okay, how is this person getting paid? And what investment strategies are they getting paid? Because ultimately it's about you growing your wealth. That's what we all stand for here. And so it frustrates me though that so many people, and I've seen a lot of financial planners be blatantly saying that you cannot, the very thing we're talking about, which is just complete nonsense, right? And so because they're not getting paid on the back end of that. So I just think we need to be really careful and stewards of our money and say, okay, where am I headed? What do I want to build? And what do I have in front of me? And then making sure we have the right team around us, tax deferred. You were saying, make sure you're in the right account for your own retirement money. Now let's go on the other side of, I'm listening to this. I want to buy my next property. And I'm tapped out with my own money. I've leveraged my own money. I have 5, 6, 7 properties, but I know I can utilize and work with others that have a self-directed. I just don't know how to have those conversations. And I don't know what kind of deals I can use it for. Give me a little bit of information. Let's give them a little more information on the opportunity. And then we could talk about how we could structure it.
Absolutely. Now, this is my favorite topic, right? Capital raising through self-directed IRAs, because it's the other side of it now. You're not coming from the investor side. Now you're coming from the syndicator side. So you have this deal, and we will definitely talk about creative ways to structure deals within a self-directed IRA, all compliant by IRS. But you have a deal. The first things first is you want to make sure it's compliant and you are able to accept retirement money. And typically in real estate, almost all deals are compliant because real estate is one of those popular asset classes where retirement funds are able to be invested in. The next step definitely is doing your research and finding a proper custodian. Before you even start having conversations with potential investors, you need to confirm the whole process has been outlined, because you never want to be in that situation. You had the conversation with the investor is ready. You're like, wait a minute, I need to now go find a custodian. Having that relationship pre-hand with the custodian is amazing, because one of the things, especially I know that me and my team does, is we actually help our investment sponsors or our real estate syndicators have these conversations with the investors, where we will be there to support them, especially when the investors have tax-related questions or SDIRA-related questions, right? So you want to have a conversation and pick a good custodian and make sure you understand the entire onboarding process from Open Fund Invest, so you know what your investors will go through. And then finally, now this is where we really start getting, on the ground, boots on the ground, let's do this. You need to start having conversations with investors. What I always tell my investment sponsors is you need to have multiple funding sources for any deal, right?
Yeah, that's
Because
the truth.
you can't fund the entire deal with just retirement, and you can't fund the entire deal with non-qualified cash, just cash, the taxable cash of investors. You want to give them options. Hey, you can get into this deal, either debt or equity. We'll talk about different structures in a minute. You can use your money that's either in a savings account or checking account. These are the limits. Or you also can use your retirement, or you can use both. Giving them that option up front. Hey, these are the ways you can get into this deal. Showing it, putting it on paper and showing them this is the way you can do this. And this is who we work with. If you have any questions, you can work with, like, say, Donna at Madison Trust. That just helps ease the conversation, because sometimes I've realized the sponsors don't even have the conversations. They show them that this is possible, and then the investor will set up a consultation call with us, ask us the questions, and they will decide they want to invest. So it's really that easy. And I say this, and I don't say this lightly, that it's that easy to raise capital, but it is once you tell people you have amount of money, especially if you just move jobs, you have that $100,000 lying in your 401k. You were already looking at this deal anyway, and you were willing to pay the tax consequences by investing in it. But now I'm giving you the opportunity not only get tax advantages, but to grow your retirement portfolio. So
Absolutely.
It's that conversation, really, Liz.
And I think that's so important. We've been raising capital for over 15 years. And even one step before that is the conversation of knowing what people's goals are financially with their retirement accounts. Because just like a great financial planner, they're going to ask those questions, right? And so in essence, if you are a sponsor for your new construction deal, or you have a long-term equity syndication, multifamily project, or fill in the blank, that is your fiduciary responsibility to ask and ensure that how this person who has a self-directed IRA and has retirement dollars, what are their goals with that? Obviously, to make money is obvious. I mean, that's okay. Let's put that aside. But their goal might be in 5 years, their oldest is going to be in college, and they want to have more, they're going to hit retirement age that they can start taking money out. So they really want to build it to X. They might want to be a little more aggressive. They might not want to be aggressive with their investment strategy. So knowing where a person is when they have a retirement account, especially whether you're looking at various deals, the deal that you're looking at has to match with what this person's goals are. And I don't say that lightly, because raising money from other people is a really big responsibility.
It is a huge responsibility.
Huge responsibility. Huge. So you have to take it accordingly. So, because often I'll ask the women in the InvestHER community, I'll say, she goes, I'm raising capital for this. And so what is the person's goals? I didn't ask them that. Yeah, that's a really big one, especially their lifestyle goals and their financial goals. Yeah, because anything you put their money into has to align accordingly. Right, Dana?
Absolutely. And just to add on to that, Liz, and I love that you bring it out, because it's absolutely true. And a lot of financial planners, financial advisors, they talk about retirement portfolio, but they never talk about this other world out there of alternative investments, where alternative investments are beautiful to me, and I love this industry, because if you're risk tolerant, risk averse, high risk, there's always an asset class for you. Even in real estate, you can find all different type of asset classes to match it. But at the end of the day, this is something I really want to speak with the InvestHER community, and I'm really excited to be part of the InvestHER community, is when you are having conversations with investors, it's not a one and done conversation. And I see this mistake happen a lot in the capital raising world. They think it's short term. These relationships you're building with the investors are a long-term relationship. So you want to take the time to get to know the investor in a more deeper personal aspect. So asking those questions also builds that trust and loyalty, not just between you and the investor, just overall in your deal. Because
absolutely,
it's a huge responsibility taking someone's money. It's even a bigger responsibility when you're taking retirement money, right? That's the money people always think about. Hey, that's the money when I'm done working, I can comfortably retire. So asking that, what are your retirement goals? What do you see? What's your risk tolerance here? What sort of asset classes are you working for? Even that conversation builds that credibility. And not just that, let's say it doesn't work out for that deal, because after having the conversation with the investor, you realize this deal is not the deal for this investor right now. Trust me, you still got an investor for life. Because now, anytime a new deal comes out and you set up a call with that investor, they will always pick up the phone to hear you out, because they know that you are looking for their best interest at heart.
Yeah. And you can float kind of like mock deals. I'll give you a good example. Often people think that you can only utilize other people's, retirement money in syndications or long-term equity, and we'll get to structuring it. But debt and loans are actually one of the best ways, because it's a little more short-term.
Mm-hmm.
And we had a new construction project that we had done, Andres and I, and we had a bank, an institutional bank lined up, community bank, but we needed the down money. We needed the down money, and we needed some of the acquisition of the land. And we were able to work with now they were in second position, but we were able to work with a lender. He had his money in a self-directed. He lent us $300,000. And that was, the way we're able to get the deal done, and having a traditional bank lined up. Now, he was in second position. And something I always like to say, and I'm sure you've seen this, Dana, is that you can get creative in saying, okay, what's the percent you would give him? Or what can you do there? It's a private money opportunity. So you can negotiate with that person accordingly. At the time, we gave him 8% on his money, all the interest to be paid at the end. We also gave him upside of the profit made, because he said, I'm in second position, which I don't like being, but I've done deals with you guys before. I want to see something on the upside. So we ended up giving him 12% of any of the profit, not any of the profit, because we did make money. We made a good amount, but we gave him 12% of the profit. He ended up walking away, Dana, with $46,000 from a 10-month lending his $300,000 to us. You can imagine he was happy, but more importantly, his question was, what's the next deal? What are we doing next?
Exactly.
Because the last thing someone who has a retirement account wants to have is their money back in the retirement account, because guess what? The money isn't working. So that's the kind of strategy that you can set up as you're raising capital. I'm sure you've seen those structures on your end, especially right now with new construction or flips, short-term projects. Have you seen a lot of that right now, Dana?
So much. So let's really dive deeper into what you were saying there.
Yeah, please.
The creative deal structuring within the self-directed IRA. And I love what you, Andresa, and the investor did, because it's a negotiation at the end of the day. You're not working with a financial institution where you're restricted. And that's what I love about self-directed IRAs. The old investment style with the self-directed IRAs, of course, is syndication, GPLP structure, it's equity. The world's changing, the economy's changing now. And the last few years, I've been seeing a huge shift towards private credit. So deals very similar to you, right? People want to lend money out. Few reasons why they want to lend money out. And it could be short-term or long-term. I've seen promissory notes, year, 2 years, 5 years, 10 years. I've also seen promissory notes, 3 months, 6 months, 10 months, like you just said. The interest rate is, again, negotiated between the deal, the sponsor, and the investor. I've seen interest rates from as low as 5% to as high as 15 to 18%, depending on the risk of the deal, depending on the maturity of the deal. I have seen, and you're going to be very surprised, I've seen promissory notes completely unsecured. I've seen promissory notes secured by collateral that isn't real estate. Most of the time it's real estate, but sometimes there has been other sort of collateral that they have used. Other than debt, I have seen joint venture agreements, profit sharing agreements, minority interest in LLC agreements. There has been the world of real estate, in my opinion, especially in self-directed IRAs, it has gotten so creative. I have seen investors, husband and wife, utilizing their IRAs to invest into the deal. I have seen an investor using their traditional and Roth IRAs to invest into a deal. One is doing equity, one is doing debt. Just really maximizing on to capture that return. So there's so much, and it all starts with, what is your deal and how do you want to structure it? And how efficiently you want to structure it, and what's the most in demand deal structure out there. But to your point, private credit right now, lending through self-directed IRAs is insanely popular. I've actually seen people going back to a sponsor being like, hey, I don't want to be an LP in this deal. I want to be a creditor. Can you set something up? Immediately, they do that. Mezzanine financing, right? Convertible promissory notes. Start off with debt. And depending on certain clauses, conversion terms, it could turn to equity. Again, extremely flexible for both the sponsor and the investor. And I could talk about this all day, Liz.
I love it. But, it's the creative deal structure is a, how do I say? It's a skill set that more and more investors need to keep working on, meaning deal structure when you're, buying that first, second, third, fourth, fifth property with your own money, with your own bank relationships is one thing. When you start to get into working with other people's money and maybe getting into larger projects that are a little more complex, that creative deal structure matters. It's really the answer of whether I'm going to get the deal done. That, of course, makes sense financially or not get it done. And I think so many people, especially so many of the women in our community I see, shy away from that. So what are some first steps, 1, 2, 3 steps that I can take? I'm ready. I have the deals. I have the people who have said they want to lend to me from their self-directed or from their savings. I just don't know what to do next. I don't know what to do first, second, or third. So I can start moving the needle on raising money for that next property. What would you say to them that they should do first?
Perfect. Now, if they already have the deal, they have the deal structured, and they've already spoken to the investors, they've done most of the legwork. Most of the hard work is done. They have the investors saying yes, right? Then the first step is now speaking with your custodian. Now, this is why I said even before you start with anything, you want to have a custodian lined up already, because once the deal is structured, the investors had said yes, the next step really is bringing the custodian in so you can get the investors onboarded with their self-directed IRAs and getting the funding into their self-directed IRAs and making sure the investment documentation, whether it is a promissory note, it is an LP agreement, it is a JV, is properly completed so that we are ensuring that the investor's retirement money is protected. And this is something I know at Madison Trust, we take care of for the investment sponsors. We assist the clients get onboarded, complete their investment documentation so they don't feel like it's very complicated. The second step is always keeping the communication lines open. Keep talking to the investors, providing them updates, working with the custodian, knowing where everyone is at the step of the way. So if something happens, for instance, this happens all the time. Most of the time, a lot of 401ks, 403bs, they send the funds via check. We call it snail mail. They just send it and and the investor has no idea where the money is. The sponsor definitely has no idea the money is. So we can put some things in place to prevent that. Hey, let's figure this out so we can track. But it's all about communication. And then finally, of course, funding, investing into the deal and getting it done in a way it doesn't cause the investor stress. Because sometimes we've seen deals fall apart because the process was too complicated for the investor and they backed out. Sometimes they can pledge the commitment, a verbal commitment, but then if they realize the paperwork is too much, they back out. So really the first, second, third step is have your custodian ready. Get your investors introduced to your custodian so they can start the onboarding process and then continue to have those clear communication between the investor and the custodian up until the deal is invested, but then also after the deal is invested. Keep providing those quarterly updates or monthly updates so that both the custodian and the investor is aware on what's happening.
Yeah, that makes so much sense. And so often we're not moving the needle forward on getting things set up because we don't have a contract in place. But all of these things, talking to the investor, getting your deals moving, all of this could be happening, right? And it's really important to start the process so that you have your, as they say, your egg, what is it? It's something
Ducks in a row.
Yeah, there you go. Thank you. I'm like, forgot the phrase, but it's so important. And what I really love what you're saying is that just like our community, there's so many ways to get creative in deal structure to meet the needs of the investor, to meet the needs of the deal. Because the deal has to make sense at the end of the day, right? Somebody wants 15% interest And it just, okay, that's great. It may not make sense for the deal. So three entities needs to make sense. The deal, the investor, and yourself as the steward, as the person who's pulling the deal together. All three of those things are important. And I think it's so important to be talking to custodians, be talking to other investors that have done these type of creative deal structures, because it's not like this book of deal structures. As long as it's legal, it makes sense for the deal, the investor, and yourself. And it's obviously within the constraints of the custodian. You're not breaking any rules. It's legal. It's really, there's more creativity than people even realize. And that's what I love about InvestHER Con. And I know, Dana, you're going to be there with your team. We're going to be doing so many hands-on workshops. Dana's going to be speaking as well. And the whole goal of this conference, right, is to not just talk about deal structure or talk about, is this a good deal or not? We're actually doing hands-on, workshops and opportunities for people to really analyze deals, to actually meet other people. One of our pre-networking event, we have Beth Johnson's going to be talking a little bit about being a lender versus being someone who needs that money, right? And how do you connect? And what are the questions you need to ask each other? Just like Dana and I are talking about. So super hands-on. If you don't know about InvestHER Con, I don't know where you've been, but would love to see you. And personally, thank you for being there June 1st to 3rd. It's going to be a very transformational 2.5 days. So Dana, I'm so excited to see you there. I'm so excited to see your team there. Where can everyone listening learn more about you guys before that?
I am very excited to be a part of InvestHER Con. And just in general, Liz, thank you for including us, Madison Trust, as a part of the investor community, because I love, first of all, there's nothing like, women helping women, especially in an industry that sometimes are long forgotten, but we have some powerhouses of women in this industry that I've actually had personal pleasure of working with. So I'm very excited for InvestHER Con. But for anyone who wants to learn more information on self-directed IRAs, and whether it's for your own personal finances or for your deals to raise capital, visit us at madisontrust.com. And of course, feel free to follow me on LinkedIn, Donna Udumulla. Feel free to send me a message. I'm always happy, and you can find my Calendly link on our site as well. I'm always happy to set aside some time and just discuss, because I've seen a lot of different deals in my time, in my tenure at Madison Trust, things that have worked, things that haven't. And I always love just having the conversation, because at the end of the day, it's not business. It's really relationship building. And that's why I really love the investor community. Like you said, it's not about, is the deal good or bad? It's really about getting hands-on, asking the right questions, knowing it, and building long-term relationships. So we are very excited. We can't wait for June.
Awesome. We'll put all that in the show notes. Dana, thank you so much for all your insight today. And thank you for being here.
Thank you for having me, Liz.